You are watching Daily Market Pulse. Today is Monday, May 4, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Is AI about to crash prices, or will government spending save us? Here is the framework for today's briefing. AI's deflationary shock. Understanding how AI could fundamentally change price levels and wages. The fiscal stimulus boom. How deglobalization and national security are driving massive government spending. Bitcoin's inflation hedge tested. Can Bitcoin still be the go-to inflation hedge in an AI-driven deflationary world? Geopolitics and energy prices. How Middle East tensions are impacting oil and complicating inflation outlooks. Regulated markets and institutional adoption. The rise of prediction markets and their impact on crypto legitimacy. Daily financial market update. Live prices. Gold, silver, crypto, equities, US bonds, and trend. First, let's talk about the big tech story that's on everyone's mind. The biggest story shaping our economic future is the rise of artificial intelligence. And it's not just about new gadgets or faster computing. We're seeing real anxiety among young workers who fear AI will take their jobs. But the real economic impact is its potential to create a powerful deflationary shock. Think about it. If AI makes businesses dramatically more efficient, it could drive down the cost of goods and services significantly. Some analysts believe this deflationary force could be even more impactful than the internet revolution. This isn't just a minor shift, it's a potential supply-side shock that could permanently lower price levels and wage growth. This poses a direct challenge to central banks trying to manage inflation. It's a complex dynamic that investors need to understand as we navigate this new technological era. On the flip side, governments are injecting massive amounts of cash into the economy. While AI is creating deflationary pressures, there's another massive force at play: government spending. The world is shifting towards deglobalization, and in response, governments are preparing for a huge spending spree. Think infrastructure, defense, and energy projects. Bank of America predicts global government spending could jump 15% by 2027. This isn't just about spending money. It's about stimulating economic growth and boosting corporate profits. It creates a boom loop where government investment fuels further economic activity. This fiscal stimulus is a powerful bullish factor for stocks, especially in areas like AI infrastructure. We're already seeing the market react, with stocks climbing today. The US 10-year Treasury yield is holding steady at 40%, reflecting this ongoing economic activity. Keep a close eye on upcoming fiscal spending data for clues on the pace and scale of this government-driven boom. Now, how does this all impact Bitcoin and the crypto market? So what does all this mean for Bitcoin and the broader crypto market? It's a complex picture. On one hand, Bitcoin is getting a boost from institutional legitimacy, especially with regulated prediction markets like Kalshi gaining traction. Fiscal stimulus is also driving risk-on flows into digital assets. However, the deflationary shock from AI is a significant challenge to Bitcoin's long-held narrative as an inflation hedge. If prices are falling, the need for an asset to protect against rising prices diminishes. This means Bitcoin's medium-term performance could hinge on whether the sheer amount of cash injected into the economy can offset this deflationary pressure. Alternatively, the narrative might shift, with investors viewing crypto more as essential digital infrastructure. Bitcoin is currently trading at $80, 340, showing some resilience. We're seeing strong on-chain accumulation signals, but there's also skepticism about extremely high price targets. The key is to watch if liquidity can overcome deflation, or if the market starts valuing crypto for its infrastructure role. And of course, geopolitical tensions are always a major factor in markets. Geopolitical tensions remain a significant driver of market sentiment, and the situation in the Middle East is no exception. The ongoing war in Iran is creating substantial energy price shocks. WTI crude is now trading above $101 a barrel, a level that directly impacts inflation. While oil prices have seen some fluctuation today, they're up a significant 12% over the last month and a remarkable 77% higher than a year ago. This surge in energy prices is a major headache for central banks like the Federal Reserve and the European Central Bank. It complicates their efforts to bring inflation down to their target levels. This is why we're seeing gold and silver rally as safe haven assets. They're acting as a hedge against this rising inflation. The market is highly sensitive to any news from the Middle East, and this volatility in energy markets is a key factor to watch for its impact on the broader economy and investor sentiment. Finally, let's look at the evolving landscape of financial markets themselves. Let's turn our attention to the evolving world of financial markets, particularly the rise of regulated platforms. The story of Kalshi, a regulated prediction market, is a prime example. Its co-founder, Natalie Brunell, navigated intense legal battles to get these markets off the ground, highlighting a significant maturation in U.S. financial regulation. This success validates event-based trading as a legitimate asset class, which is incredibly important for the crypto space. It suggests that innovative financial products, even those that might seem unconventional, can achieve regulatory approval and attract institutional interest. This increased legitimacy and potential for greater liquidity in regulated markets could spill over positively into crypto prediction markets. While it might not directly move Bitcoin's price today, it's a crucial trend for the long-term institutional adoption and stability of digital assets. We'll be watching institutional adoption metrics for Kalshi and similar platforms closely. Now let us turn to today's live market snapshot, where gold, crypto, stocks, and bonds are actually trading right now. Now for our daily financial market update. Here is where the key asset classes stand as of Monday, May 4, 2026. Gold is trading at $4,601.50, slightly lower on the day and is slightly higher over the past 5 sessions. Silver is at $75.38, slightly lower today and higher over the past 5 sessions. In crypto, Bitcoin is at $79,830, higher on the session, strongly higher over the past 5 sessions. Ethereum is at $2,367, higher today. Other major crypto, Solana at $84.81, BNB at $628. 32 XRP at $1, 4,113. On equities, the S&P 500 at 7,230, 12, slightly higher. The Nasdaq at 25,114, 44, slightly higher. Dow at 49,499, 27, slightly lower. Internationally, the DAX at 24,335, 54, slightly higher. The Nikkei at 59,513, 12, slightly higher. The FTSE at 10,363, 93, slightly lower. On the bond side, the 10-year U.S. Treasury yield is at 4.38%, slightly lower on the session, and the 30-year yield is at 97%, slightly lower. Yields remain in focus as the market watches for Federal Reserve signals. Rounding out the macro picture, WTI crude at $102.68 per barrel, slightly higher. The dollar index at 98.18, flat. The picture is mixed across asset classes, with no dominant directional theme yet. Investors are watching macro catalysts closely before committing to a clear risk stance. So what does today mean for you? The market is wrestling with a huge question. Will AI's efficiency gains lead to falling prices, or will government spending on infrastructure and defense create a new boom? For now, it's a mixed bag with opportunities in infrastructure and energy, but caution advised on AI's long-term deflationary impact. Keep an eye on those U.S. Treasury yields and institutional adoption of new trading platforms. Thank you for your attention, and we will see you again tomorrow.